Hi guys, welcome back to another revision video. Now we'll be covering AS2, valuation of inventories. Okay, like all our previous revision videos, let us quickly start with revising a few concepts, and then in between we'll also do certain questions. Okay, let's get started. And as you all know, inventories means assets held for sale. Any asset which you are holding to sell in the ordinary course of business. In the asset, you have it only to sell it to your customers. Those assets will be called as inventories. Whatever assets you are holding it for use, that will be either PPE or intangible, but whatever asset is held for sale in the normal course of business, that will be called as inventories. AS2 will apply to that. Okay. Now if you see, there can be two types of companies. One is trading and another one is manufacturing. And I hope you all know the meaning. Trading means they will buy and sell. Manufacturing means they will buy the raw materials, process those raw materials and sell the finished products. Now in trading, we will have only one type of inventory, which is called as finished goods, FG. But in manufacturing concern, we will have raw materials, we will have something called as WIP, work in progress. These are semi-finished goods, and then we will have finished goods also. So manufacturing entities will have more types of inventories compared to trading concern. A trading concern will have only finished goods. Okay, so as I told here, inventory includes raw materials, WIP and finished goods. It excludes items like spare parts, standby equipment and servicing equipment which satisfy the PPE definition in AS10. They will be accounted as PPE under AS10, not under AS2. So this spare parts, standby equipment, servicing equipment, if they meet the definition of PPE, then they will go as per AS10. They will not come to AS2. Okay, and we all would have learnt in detail the scope of AS2. All those detailed points are not really very important from revision perspective. One very important point in scope exclusions from AS2 perspective is producer's inventory of livestock. That means, assume you are a farmer. You are the one who is actually cultivating paddy. So for you, though that paddy is held for sale, actually AS2 is not applicable to you because these are agricultural and forest products and you are actually producing. So this AS2 is not applicable for inventory in agriculture and mining industries. Remember, it is not applicable only for producers. Only for producers. You should be the actual farmer who is producing that paddy, or you should be the actual person who is mining that minerals. Only then for you AS2 will not apply. Let us assume there is Mr. A who is a farmer. He is cultivating paddy and he is selling that paddy to Mr. B. Mr. B will convert that paddy into rice and sell it to people. Now Mr. A is the actual producer. For him only AS2 will not apply. For Mr. B, he is not the actual producer, he is just a trader. For him, AS2 will apply. This was a question asked once in the past exams. So only for producers. You should be a producer of agricultural products. You should be a producer of these mineral ores, natural gas. That means you should actually go and mine them. Only then for you AS2 is not applicable, because generally in these industries they have an established practice of valuing inventory at NRV. Okay, remember this. There's one question that was asked in the past on this particular point where he was actually a trader, but many people will not read that whether he's a trader or producer. The moment they see agriculture, the moment they see forest products, the moment they see mining, they will say AS2 is not applicable. They will not bother to read the entire question properly. So please read the question properly. Only if he is the producer, AS2 will not apply. If he is not a producer, he is just a trader, AS2 will apply for him. Okay. Sir, now how to measure these inventories? How to measure these inventories? Very simple. Okay, let us learn this in two aspects. The measurement principle we will be learning separately for FG and WIP, and for RM we will be learning the measurement principle separately. For FG and WIP, that is for finished goods and work in progress, these finished goods and work in progress will be valued at cost or NRV, whichever is lower. They will be valued at cost or NRV, whichever is lower. That is what I have given in this chart also. Lower of the following, one is cost and another one is NRV. The full form is net realizable value. Okay. Sir, how to calculate cost? Cost has three components: cost of purchase, cost of conversion, and other cost. Cost of purchase is nothing but that raw material ka purchase price. In that you will take that raw material ka purchase price, you will add non-refundable taxes. In other words, you will add indirect taxes for which there is no ITC, for which there is no input tax credit, like customs duty. GST generally will not be added, because generally in most number of cases, in case of GST we have ITC, but in case of customs duty we won't get that ITC, so customs duty will be added. Even in case of GST, sir, what if it falls under blocked credit? If it falls under blocked credit, then there is no ITC, then you can add it to the cost. If there is ITC, the tax should not be added to cost. So purchase price plus taxes which are not refundable minus trade discount, if you do, you will get cost of purchase. Same way, how to calculate cost of conversion, sir? Cost of conversion, you will take labor cost. You will see what is the total labor cost, that you will divide by the actual number of units you produced. You will get the per unit labor cost. Then very important, production overheads. You have learned this in costing also, but costing and accounts is slightly different here. Labor cost will be taken, which is a cost incurred for converting the raw material into finished goods. Then you will also take production overheads. Here remember carefully, production overheads are split into two: FOH, VOH. Sir, what is this FOH, VOH? FOH is fixed production overheads. VOH is variable production overheads. Remember here carefully. In case of fixed production overheads, to calculate per unit cost, first come to this mindset. What we will do, most of the sums, how will it be given is, he will give us total cost. That we have to divide by certain number of units, arrive at per unit costs, that we will multiply with number of units that are there in the inventory to calculate cost of the inventory. So here very important is how to arrive at that per unit cost. For labor cost, very simple, divide by the actual production, you will get labor cost per unit. For fixed overheads we should be careful. Remember, sir, how to calculate for fixed overheads per unit cost. In the question they will give you normal capacity and they will also give you actual production. Okay, they will give you normal capacity, they will also give you actual production. Suppose case 1, let us assume actual production is less than normal capacity. In that case, in your costing terms, you have learned this as underutilization. If there is underutilization, then fixed overheads, to calculate per unit cost, you have to divide that by normal capacity. Remember, if there is underutilization, that is if the actual production is less than the normal capacity, if there is underutilization, then to arrive at fixed overheads per unit, you have to divide by normal capacity. That you multiply into number of units of inventory, you will get how much fixed overheads you should include in the cost of inventory. Sir, okay, this is okay. What if there is overutilization, sir? That is actual production is greater than normal capacity. Here only costing and accounts are totally different. If actual production is greater than normal capacity, that is if there is overutilization, then to calculate per unit cost, fixed overheads should be divided by actual production. Keep this in mind very strong. If there is underutilization, divide by normal capacity. If there is overutilization, you have to divide by actual production. This you have to be very strong in this. For variable overheads, very simple. To calculate per unit cost of variable overheads, you will divide only by actual production. There is no concept of normal capacity for variable overheads. Okay. So then what is this other cost? other cost can be borrowing cost if inventory is a qualifying asset, or if there is any other customization charges. Customization, somebody is asking you to design this inventory in a particular way. For that you are incurring some design charges, or you are using some assets for the purpose of manufacturing this inventory. Depreciation, amortization of those assets will also be included. So all these if you add, you will get total cost of the inventory. This total cost of the inventory should be compared with NRV. Sir, how to calculate NRV? Listen, NRV you should take selling price minus cost to sell the product. Remember, take selling price minus cost to sell the product. Sir, any example for cost to sell the product? Famous example is commission or brokerage. Suppose assume you told your salespersons, what you told your salesperson is, if you sell 1 unit, per each unit that you sell, I will give you 2 rupees as commission. Then the 2 rupees will be cost to sell that unit. Remember, here in cost to sell, we should take only those selling costs which are directly attributable to per unit level. For example, advertisement cost, it is not a cost which is attributable to each unit. So we should not take all the selling costs, we should take only those selling costs which are directly attributable per unit. So take the selling price, subtract directly attributable selling cost, you will get NRV of FG. You will get NRV of FG. Sir, how to find out NRV of WIP? From this NRV of FG, subtract cost to complete the product, because WIP is only in progress, so you have to incur further cost to complete that. Whatever is cost, that also you subtract, then there will be a subtotal which will be NRV of WIP. Simple. To calculate NRV of FG, you should take selling price minus directly attributable cost of sales, you will get NRV of FG. Then from that again subtract cost to complete the production, you will get NRV of WIP. This you can compare with cost of WIP, whichever is less will be the value that will be shown in the balance sheet. Is this very clear? Sir, finished goods and work in progress, okay. What about raw materials? Please be careful. This raw materials is the place where many students have a confusion. It's a simple principle. I don't know, still many students get confused. Sir, what to do for raw materials? Listen, first, for raw materials, what AS2 is telling is, see, at FG level, first check if there is any problem. Sir, what do you mean by problem, sir? Problem means, in the FG, check whether cost of FG is greater than selling price. Appana in the FG oda cost, adoda selling price oda adhigama irukku. It is more than selling price. Then AS2 is telling it's a problem. Cost is more than what you can recover. And the mari, if there is a problem at FG level, then AS2 says, okay, come to RM also. RM will have a cost. That cost of raw material should be compared with something called as replacement value. Sir, what do you mean by replacement value, sir? Today, if you want to go and buy the same raw material, what will be the cost? That is called as replacement value. Remember, first go to FG level. See at FG level whether cost of FG is greater than selling price of FG. Yes, sir. Cost is greater than FG. Cost is greater than selling price of FG, sir. Then there is a problem at FG level. Then come to RM. At RM level, take the cost for the raw materials. Compare that with replacement value. Whichever is lower will come in the balance sheet. Able to understand? This you should check only if there is a problem at finished goods level. If there is no problem at finished goods level, then no need to even check for raw materials. You can value that cost, and that cost can be shown in the balance sheet. So first thing, see at finished goods level. If at finished goods level cost is greater than selling price, then there is a problem at finished goods level. Then come to raw materials, take the cost of the raw materials, take the replacement value, whichever is lower will come in the balance sheet. Is this very clear? Sir, FG la problem illa sir, cost is less than selling price sir, selling price only more sir, future I'm going to get profit sir, so no problem at finished goods level sir, then don't disturb raw materials. Whatever is the cost of raw materials, that will come in the balance sheet. Hope you are very clear with these measurement principles. Please, this is the core of AS2, and whatever I have explained for factory overheads and that is your production overheads and direct labor, it is given in this chart, clearly summarized. Okay, credit goes to your institute. They have given a very good summary like this in the book. Okay, so let us do one question based on these measurement principles, then we'll go ahead with the further concepts. Okay, first question, this is a past question asked in the exam. A Limited is engaged in manufacturing chemical Y. For which raw material X is required. So raw material is X and the finished goods is Y. The company provides you the following information for the year ended 31st March 2017. What they say is, for raw material, the cost price of raw material is 380. Then there are some unloading charges to unload the raw material, and there is transportation cost for the raw material. So if you see, essentially the total cost of the raw material is 440. 380 is the material cost, unloading charges 20, 380 plus 20, 400, plus there is transportation cost, 400 plus 40, 440. And replacement value of raw materials is 300. Let us see what to do with this later. Now let's, for chemical Y, material cost 440. Labor 120, variable overheads 80 per unit, so totally 560, 640 per unit. Sir, wait. Total fixed overhead for the year is 4 lakhs on a normal capacity of 20,000 units. Sir, now in this question they have not given us actual production, sir. So how do I know whether I should take actual production or normal capacity? If they have not given actual production, then we will divide by normal capacity and find out the per unit cost. So 4 lakhs divided by 20,000 will give you 20 rupees is the cost per unit, fixed cost per unit. So 640 plus 20, total fixed cost per unit is 6,600. Okay, and second point in additional information, closing balance of raw material X was 1000 units and chemical Y was 2400 units. Okay, now Kavani, you are required to calculate the total value of closing stock of raw material X and chemical Y according to AS2 when the net realizable value of chemical Y is 800. Case 2, net realizable value of chemical Y is 600. Let us do these two cases. Now if you see, first this chemical Y cost per unit is 660, and in case 1 NRV is 800. So it will be valued at cost or NRV, whichever is less. 660 or 800, whichever is less, it will be valued at cost itself. So there is no problem at FG level. Even RM will be valued at cost only, which is our 440 rupees. So RM also will be valued at 440 per unit. So 660 per unit will be the cost of chemical Y, and RMX cost per unit will be 440. So 660 into 2400 will give you the total cost of FG. At the same time, 440 into 1000 units of closing stock will give you the total cost of raw material X inventory. So if you see 1000 into 440, 2400 into 660, we will get the total value of closing stock in case 1. Sir, what about case 2? Listen, case 2, cost of chemical Y is 660 per unit, NRV is 600. So chemical Y will be valued at 660 or 600, whichever is less. Since NRV is less, it will be valued at 600 per unit into 2400. If you do, you will get the total cost of the closing stock of chemical Y. Now see, at finished goods level, NRV is less. So that means there is some problem at finished goods level. So AS2 says, come to raw material also. Okay. Raw material, what is the cost per unit? Raw material cost per unit is 440. How much is replacement value? Sir, is it given in the question? Yes. Replacement value per unit is 300. Replacement value per unit is 300. So 440 or 300, whichever is less. Obviously 300 is less. So per unit of raw material will be valued at 300. So 300 into 1000 will give you the cost of the raw material closing stock. So 1000 into 300, 2400 into 600. Here be very clear with the raw material principle. If there is a problem at FG level, then come to raw material, take the cost of the raw material or take the replacement value, whichever is lower. If there is no problem at FG level, we will not disturb the raw materials. It will be still valued at cost. I hope this is very clear. Second question. The expected production for the year was 15,000 kg. This expected production is there. No, if they call it as expected production, that is only our normal capacity. Okay. Now opening inventory of finished goods is 1000 kgs. Current year raw materials purchase is 1100. Current year, sorry, this is opening inventory of raw materials 1100 kgs. The cost is also given. Purchases is raw material purchase. Always remember, in a manufacturing company, what they purchase is raw materials, what they sell is finished goods. In a trading company, what they purchase is also finished goods, what they sell also is finished goods. So here they are purchasing raw materials 10,000 kgs raw materials they are purchasing at 1 lakh. Labor they are spending 76,500. Fixed overhead 75,000 they are spending. Sales they are selling 10,000 units. Guys, this sales is FG sales, not raw material sales. And then closing inventory of raw materials is 900 kgs and closing inventory of finished goods is 1,200 kgs. Now let us see what is the additional information. Due to fall in market demand, the sales price for the finished goods was rupees 20 per kg and the replacement cost for the raw materials is 9.5 per kg on the closing day. You are required to calculate the closing inventory as on that date. Let's get started. Now if you see first thing, see how you should think in this question is, in the opening stock in FG, you had 1000 units, correct? See, in this question, normal capacity is given, but actual production is not given. That we have to find out. We have information in this question to find out. Okay. Opening stock of FG is 1000 units. Let us assume current year production is X units. Because that is not given, we have to find out. Closing stock of FG is how much? 1200 units. And how many units we sold? 10,000 units. Now you all know opening stock of finished goods units plus whatever I have produced in the current year minus whatever I have in closing stock should give me units sold. Yes or no? Whatever I had in opening, whatever I have produced in the current year minus whatever is there in my closing stock, balance will be units sold. That means 1000 units plus current year production, which is X, minus 1200, which is closing stock, should be equal to 10,000 units. So in that case, actual production will be 10,000 plus 1200 minus 1000. So actual production will be 10,200 units. Able to understand, actual production will be 10,200 units. So if you see now, actual production 10,200. But normal capacity is 15,000. So underutilization or overutilization? It is underutilization. To calculate fixed overheads per unit, you should use normal capacity. Normal capacity. Hope I am very clear with this. So let us calculate closing stock with this now. We have manufactured 10,200 units. Correct? Now on the 10,200 units, material cost venuma, material cost is required. Sir, what is the material cost? If you see, you have purchased 10,000 units at 1 lakh. That means 10 rupees per unit. For this 10,200 units, you would have spent 10 rupees per unit. So your total material cost will be 1 lakh 2,000. Sir, what about labor cost, sir? You have spent 76,500 for 10,200 units. That means per unit will be per unit will be, just a minute, let me calculate this. $76,500 divided by 10,200. It will be 7.5 per unit. I have produced totally 10,200 units. So into 7.5 will again give me back that 76,500. Next, fixed overheads. Careful. We have spent 75,000. Now to find out per unit cost, we have to divide by actual production or normal capacity. Is underutilization case or overutilization? Underutilization. So you have to divide by normal capacity, which is 15,000. So 75,000 divided by 15,000, 5 rupees per unit. Total production is 10,200 into 5 will give you 51,000. So total cost is 1,02,000 plus 76,500 will be 1,78,500 plus 51,000. 1,78,500 plus 51,000 will give you 2,29,500. So this is what I spent for 10,200 units. That means per unit I have spent 22.5 rupees I spent per unit. So cost per unit is 22.5. How much is NRV? How much is NRV? 20 only. So it should be valued at 22.5 or 20, whichever is lower. So per unit it will be 20. So 1,200 units I have in closing stock. So 1,200 into 20, 24,000 will be the value of my closing stock of finished goods. Sir, what about raw materials, sir? Finished goods, so there is a problem. For raw materials also, we should take cost or replacement value, whichever is less. Sir, what is the cost per unit of raw materials? 10,000 units you purchase for 1 lakh. Each unit is valued at 10 rupees. But what is the replacement cost? 9.5. So 10 or 9.5, whichever is less, it should be valued at 9.5. How many units you have in your closing stock of raw materials? 900. So 900 into 9.5. 8,550 will be the value of closing stock of raw materials. This is a very interesting sum. Ensure you practice once more. I hope you are very, very clear with this. So raw materials will be 8,550. Closing stock of finished goods will be 24,000. Totally will be 32,550. Clear, everybody, clear. Let us finish question 3 also, and then we'll finish the remaining concepts. Next, question 3. I hope you understood. So finished goods, if there is a problem, for raw materials we have to calculate cost or replacement value, whichever is less. In finished goods cost valuation process, please once again be very, very clear with fixed production overheads. If there is underutilization, you will divide by normal capacity. If there is overutilization, you will divide by actual production to find out per unit cost. See, this question I wanted to mainly discuss because of C point. A and B are easy, you can try. C point, the main I want to discuss. Here students will make a mistake. Shirts which had a cost of 50,000, their net realizable value as at the balance sheet date was 55,000. Commission at 10% on sales is payable to agents. What should the inventory value be according to AS2 after considering the above items? I will tell you what students will do, Cost 50,000. NRV is equal to 55,000 minus 10% commission. So 55,000 minus 10% is 5,500. 49,500 NRV. Cost to 50,000. NRV 49,500. Whichever is less, it will be at 49,500. IC will give you 10 because it is wrong. Sir, what is it wrong, sir? You only told no, sir. To calculate NRV, it is selling price minus cost to sell it. If selling price is given, from that you can subtract this commission, agreed. But what is given to you itself is NRV da. If NRV itself is given, that means this 55,000 itself was calculated after subtracting the 10%. Again, if you subtract, it will become double counting. So please read the question properly. If in the question already what is given to you is NRV, again you should not subtract. So here you should compare 50,000 and 55,000. Whichever is less, it should be valued at 50,000. Is this clear, everybody? Please be careful. Read the question clearly. If in the question selling price is given, and from that selling price you can subtract cost to sell and arrive at NRV. But already if they have themselves given NRV, again you should not subtract any cost to sell. Directly take that NRV and compare with cost. Whichever is less, you can value it at that one. Is this very, very clear to everybody? Okay, please ensure that you read the question properly. That is very, very important. Next. Last question, question number 4. We have one more question also after this, but we will go back to certain concepts and come back to that one more question. Okay. Question number 4. Z Limited ordered 13,000 kg of chemicals at 90 per kg. The purchase price includes 5 rupees excise duty. Remember, always excise duty will not have any ITC, so it is no ITC taxes which are not refundable, so it should be added to the cost. Okay, sorry, I'm really sorry, but here they have mentioned in the questions, the purchase price includes excise duty of rupees 5, in respect of which full SENVAT credit is admissible. Okay, this is slightly old question, that's why they are using SENVAT and all, but now if they want to ask, they will change it to GST. Okay, sorry. So for this excise duty, already input tax credit is available, so it is a refundable tax, it should not be added. Further, state VAT is leviable at 2.5 per kg on purchase price. Sir, here there are two taxes, sir. Excise duty is there, 5 rupees per kg. For this, they are telling ITC is available, so it should not be added in cost. Okay, is this crystal clear? Sir, then there is a state VAT also, sir. Now, how much is that? 2.5 per kg. Sir, now what about this, sir? Is ITC available? Remember, whenever in the question they say VAT, VAT itself means value added tax. VAT always ITC is available, so it won't come in cost. It will not be included in cost. So this excise duty also will not be included. State VAT also will not be included. Freight incurred is 30,000 rupees. That can be added. Okay. Normal transit loss, this is normal loss, which is 4%. The company actually received 12,400 kgs and consumed 10,000 kg. The company has received trade discount in the form of cash amounting to 1 rupee. This should be subtracted. The chemicals were delivered in containers. The containers were not reusable, hence sold for rupees 500. The administrative expenses incurred to bring the chemicals were rupees 10,000. Compute the value of inventory and allocate the material cost as per AS 2. Okay, கவனி ஒரே விஷயங்க பாரு, very important this one. இப்போ per unit 90 13,000 kgs they purchased at 90 rupees correct? Now listen, in the purchase price kulla they have included this excise duty for which ITC is available. Then why will you take that? So that should be excluded. Sir, this state VAT 2.5 is included, that they have not told it's included, so we cannot assume that it is included. Since it is not included, we should not subtract that. Day, remember, 90 rupees kulla already excise duty included, but it is something which we should not include because ITC is available. So subtract that 5 rupees, remove it, you will get 85. Then what about state VAT, sir? Question never says it is included. So that means this 2.5 is not even there in your purchase price. Again, you should not do anything with that. It should not be included. It is not there also. So don't do anything. Sir, what about this 1 rupee trade discount? Yes, that should be subtracted. So effective cost per kg is 84 rupees. 84 rupees. Ipa gavani, mottama how much we would have spent? 13,000 kgs into 84 per kg, correct? 13,000 into 84. Mottama we would have spent 11,31,000. Mottama we would have spent how much? 13,000 into 84. My bad. So we would have spent how much? 10,92,000. I mean, calculate my mistake. I did it as 87. So it is 13,000 into 84. 89 minus 5. 84 rupees will be the cost per kg. Sir, eppadi sir 84 are you panninga? Innoru vaati solra gavani. 90. Inside this 5 rupees is there excise duty, that should not be there, it should be removed. So 90 minus 5, 85, and there is 1 rupee trade discount, that should also be subtracted. So 85 minus 1, 84 will be the cost per kg. Totally we have 13,000 kgs. So 13,000 into 84, so it will be 10,92,000. Okay, gavani. In the 10,92,000, and for this we are also spending 30,000 freight, that can be taken. 30,000 freight can be taken. So 30,000 freight, and also we are incurring administrative cost which are incurred to bring the chemicals. Sir, but I have learnt in AS2 administrative cost should not be included. Read the AS carefully. It says administrative cost which are not related to inventory should not be included. Here this administrative cost of 10,000 is incurred for bringing the inventory, so that can be included. So we will include this 30,000 freight also. We will include 10,000 admin cost also. So total cost that we have spent is 11,32,000. This is the total cost that we have spent it. Okay, now gavani, total cost evlo 11,32,000. Sir, how to find out per unit cost? Easy sir, divided by 13,000. Angada, you are doing a mistake. Wait karo. 13,000 units we purchased. 4% normal loss. That means 4% into 13,000. 520 units will go in normal loss. Remaining actually how many units you have to get? 12,480. But you got only how much? 12,400. Sir, I should get 12,480. No sir. Why I got only 12,400 sir? Remaining 80 is abnormal loss. Abnormal loss. Guys, you have done such type of sums in your costing exam. Here also slightly it will be useful. So 13,000 units, 4% normal loss, 520 units gone. So you should actually receive that 4%, 520. Nobody can stop. That loss is inevitable. That loss will continue to happen. So 13,000 into 4%, 520 units will be the normal loss. So if that normal loss happens, we should receive 12,480, but we have received only 12,400 sir. Why sir? Because remaining 80 has gone as abnormal loss. So out of this 12,480, 80 is abnormal loss, and then they are telling, if you see in the question, they were told that they have consumed 10,000 kgs. So 10,000 kgs they have consumed, and remaining 2,400 kgs is there in closing stock. This is the actual breakup. Sir, now how to calculate per unit? Simple. 11,32,000 divided by 12,480 will give us, so per unit is 90.71. 90.71, or you can also take 90.705. This if you multiply with 80, you will get total cost of abnormal loss. If you multiply with 10,000, you will get cost of materials consumed. If you multiply with 2,400, you will get the cost of inventory, which will be compared with NRV. Whichever is less will come in the balance sheet. That is what they mean by allocation of material cost. You have to clearly allocate this 11,32,000. How much will go as materials consumed, which is 10,000 units into 90.705. How much will go into inventory, which is 2,400 into 90.705. How much is abnormal loss, which is 80 into 90.705. So in exam, if they are asking allocation of material cost, this total 11,32,000 allocate between how much is the abnormal loss, how much is the cost of materials consumed, and how much is the closing stock. Okay, I hope you are very clear with this. Now before going into the next question, let us see few more concepts. I hope you are clear with these questions. Okay. Now next interesting topic which I want to dwell upon. Okay, for this there is very interesting question that is asked by ICA. Okay, they have copied this from final book. Okay, that is JP and BP, joint products and byproducts. Now this is also there as a chapter in your costing. Here also we have that. Here what AS2 says is, if you have a joint product, then the common cost needs to be split between the joint products. For that, what AS2 is telling, use a reasonable and consistent basis. AS2, if you tell like this, what can I do? Give me some examples. For that, AS2 says, either you can split the common cost between the two products based on sale value at the time of separation. That is at split off point. You would have learnt it in costing, split off point. அப்படினா எந்த பாயிண்ட்ல இது ரெண்டு ப்ராடக்ட்டா செப்பரேட் ஆகுதோ, at the point at which it is getting separated, there will be a sale value for each product that in that ratio you split the common cost. That is one basis. Or what you can do, you can also split the common cost between the products based on sale value at the time of total completion of the products. So basically AS2 says, in case of joint products, the main issue is to allocate the joint cost or common cost across the products. For that, either use sale value at that time of split off or use sale value at the time of completion of the product. Either one you can use and you can split. Sir, we are clear with joint product. What about byproducts, sir? Byproducts will be measured at NRV. Byproduct valuation will be at NRV. That NRV will be subtracted from joint cost. Remaining what you get will be the net joint cost, which will be split across the joint products. Remember, byproduct will be valued at NRV and that NRV will be subtracted from joint cost. The net joint cost will be split across the joint products. Able to understand? Sir, what if my byproduct itself is a material one? Remember, this treatment will be followed for those byproducts which are immaterial. But if a byproduct is material, it's a very important product now, then you should use the same principle that you use for joint products. Remember this. Next point mainly I wanted to discuss is cost formulas. We'll quickly revise this cost formulas, then we will do one interesting sum on JP and BP. Once we are done with that, we can close this revision video. Okay, cost formulas. Sir, what is this cost formulas? Now think and tell me, will you buy all the inventory only at one time or different times? Sir, obviously, how can we buy it one time? We'll buy it different times, correct? Now let me explain this cost formula through an example. Actually what happens, let us see. Okay, see, suppose in my business, assume I purchased 100 units at 10 rupees per unit on 1st May 2026. Then on 1st August 26, I purchased another 500 units at 12 rupees. And then on 1st October 26, I purchased 700 units at 13. Last on 1st January 27, I purchased 1000 units at assume 15 rupees. Like this, in different phases I have purchased totally 600, 1300, 2300 units I purchased. Okay, out of these 2300 units, assume 1000 units I have sold. So that means remaining 1300 units are in my closing stock. Now I want to find out cost of closing stock 1300. Now you tell me, this 1300, whether should I multiply with 10, 12, 13, 15? This confusion is there. So to solve this confusion only, AS2 brings something called as cost formula. What do they mean, sir? They are telling 1300 units you want to value. Yes, I want to value the cost of 1300. First question A has to ask is, do you know from which bucket this 1300 is coming? Are you tracking that? Yes, yes. In the 1300 lab, from this or 400 is coming. From this 300 is coming. From this or another 300 is coming. So 4000, 400, 700, 1000. Sorry. From this assume entire 500 is coming. So 700, 1200. And from this 100 is coming. Like that you have specifically tracked which lot. Then AS2 says very good. You have tracked from which lot the inventory is coming. Super, great. Then what you do, easy to calculate closing stock. 100 units are coming from first lot. What is the cost of that? 10. So it will be 1000. 500 units are coming from second lot. Other cost 12. So this will be 6000. 300 is coming from third lot. Other cost 13. So it will be 3900. 400 units are coming from last one. So 400 into 15. Other cost will be again 6000. So total 1000, 7000, 10,900, 16,900 will be the total cost of the closing stock. Like this, if you are able to specifically identify from which lot the units are coming, then the method that you use is called as specific identification method. Sir, but I have not tracked like this, sir. Whatever I purchased, I have put in a common go down, sir. Everything is mixed now, sir. I don't know from which lot it came, sir. Then AS2 says, you can either follow FIFO or you can follow weighted average. In this, FIFO means what, sir? First in, first out. That means whatever you have purchased first, you have sold first. Do you remember? Whatever you have purchased first, you have sold first. Whatever has come inside first has gone outside. Appona first vaanginadu first vittitana. Appo whatever is there in the end, that only will be there in the closing stock. Remember, listen to this point again. Whatever you have purchased first, you have sold first. That means whatever you purchased in the end only will be in inventory. Appona enna irukuna, this 1300 will come from the last purchases, because whatever you purchased first you have sold. So this 1300 which is not sold will come from the last purchases. So what will happen? 1000 units will come from this lot. Remaining 300 units will come from this lot. So as per FIFO, the value of inventory will be 1000 into 15 plus 300 into 13. So 15,000 plus 3,900. Total value will be 18,900. This is how you will calculate under FIFO. You will assume that whatever you purchase first is sold first. So whatever is in closing stock actually comes from the last purchases. So the closing stock will be calculated based on the prices of the latest last purchases. Clear? Able to understand this? So whatever you have purchased in the last is assumed to be in closing stock. Okay, sir, this is clear. What about weighted average, sir? Weighted average, to calculate under weighted average, நமக்கு என்னலாம் இருக்கு? 100 units purchased at 10 rupees each. So totally I have spent 1000. 500 units purchased at 12. So totally I have spent 6000. 700 units purchased at 13. 700 into 13, 13 into 700, 91, 9100. And then I have 1000 units purchased at 15. So totally I have spent 15,000. That means totally to buy 2300 units, I have spent 21, 22, 31,100 rupees I have spent. Now AS2 says, calculate something called as weighted average cost per unit. Sir, how to calculate this weighted average cost per unit? Very simple. Total cost divided by total units. Sir, total cost is how much? 31,100. Total units is how much? 2300. So the weighted average cost will be 31,100 divided by 2300. 13.52 will be the weighted average cost per unit. And how many units you have in closing stock? 1300. So 1300 into 13.52, 1300 into 13.52, 17,576 will be the value of inventory. This is how you will calculate under weighted average method. Very simple. Calculate something called as weighted average cost per unit, which is nothing but total cost divided by total units. That weighted average cost per unit will be multiplied with the total number of units to arrive at the actual cost of inventory using weighted average method. I hope you are very, very clear with this. So these are the cost formulas. We have seen specific identification method, we have seen first in first out method, we have seen weighted average cost method. Sir, what is the standard cost method and retail inventory method? Under standard cost method, what the companies will do, see, this is used by matured companies which are there from long time, which have the capacity to set standards and budgets properly. So for those companies, they will follow something called as standard cost method. What they will do, they will arrive at a standard cost per unit. That standard cost only they will use it for inventory valuation also. Sir, as an auditor, what should I do if they are following standard cost method? Be very careful with one point. As an auditor, you have standard cost. That standard cost, you always compare with actual cost. If the deviation is not material, you can allow that company to value at standard cost. But if actually the deviation between standard cost and actual cost is material, sir, very big deviation, sir, standard cost is 100 rupees per unit, but actual cost only 1 rupee per unit. On the money, if the deviation is material, then you should sell management, sorry, I cannot accept your standard cost, please come back to actual cost. This is how you should talk to management if they are following standard cost method. Jerry sir, what is this retail inventory method? Now this retail inventory method is mainly used by retail stores like the Saravana stores and all the other Reliance Fresh and the retail stores. They will have lot of items. In the one item, if they do cost or NRV, they are gone. For the whole year, they will only do inventory valuation. So for them, AS2 has given a relaxation saying, Ama, I can understand your difficulty to do cost or NRV for each item. So I will give you one relaxation. What you do? You know selling price of each item. From that, subtract the margin percentage, gross margin percentage. Selling price lende margin, unak or standard or margin vechirpiya, load pannirpiya the cost ku selling price arrive panna. So from that selling price, subtract this margin percentage, remaining whatever you get, you assume it as cost. That itself will be the cost of the closing stock. Able to understand? So this is how you should do under retail inventory method. And as per AS2, you all know LIFO and simple average are not allowed. They are prohibited. You cannot generally use them. They are not recommended methods. And last important point is, see this cost and NRV comparison, you should do for each item. Assume in a company there are 3 products, A, B, C. Now for each product, you should do cost or NRV, whichever is this. You cannot say, sir, I will calculate total cost, I will calculate total NRV. Here I will see whichever is just. No. AS2 says item by item you should do cost or NRV, whichever is less comparison. That is only correct. Okay. So these are the important conceptual points which I wanted to revise. Now I want to end this revision session with one very interesting question. One of my favorites questions. This has been lifted by ICA from final book and it has been asked in one exam also. Till now I think it has been asked in one exam and one more RTP also it came recently. So one of my favorite question. Let us do this. Question number 6. Okay. The following information, listen to this question carefully, a very interesting one. The following information is available for Zinc Limited for the year 2024 to 25 day. This is taken, this question is exactly copied from your final textbook. Sir, yes sir, you are teaching final questions and all out of syllabus, sir. Day it was asked in exam, not no 2 years back itself. Sir, other we will say out of syllabus, no sir. No, in my view that is not right. This is very well within the syllabus. because AS2 also talks about JP and BP. Only thing is, this model sum is not there in our book. Whatever you cannot say, final question out of syllabus. No, Ind AS 2 also says same thing about JP and BP. AS2 also says same thing about JP and BP. So that is why recently in all our classes, when we give a question bank, we are also including relevant final questions in that question bank, so that nothing is new for you in the exam. Because if you see in the money inventory, PPE, all these Ind AS and AS are almost the same. So final level we have lot of variety of questions. Those can very well be tested even at interval, because AS10 is say almost same as Ind AS 16. AS2 is also almost same as Ind AS 2. So a student cannot really say it is out of syllabus. So that is why these type of interesting final questions, which can be applied even at intermediate level also, whatever question bank me and Satya sir have issued, that in that we have included those questions. Okay, so let us solve this question. So this company has a raw material. In closing stock they have 700 units, and they have, it is a cost price of this unit is, of this raw materials is 35 per unit, and it has a replacement cost of 20 per unit. Now we have two finished products, one is FP1, FP2, okay, and each product they have produced 3000 kgs, 3000 units and 1600 units. In that, in closing stock 500 units and 300 units are there. If you see, units are given separately, but cost is given only for one. Sir, that means FP2 free kachirka sir. You didn't get it for free and all. This is a common cost which you have to allocate to both FP1 and FP2. Okay. Fixed overheads for the year was 95,000, which includes godown rent of 15,000. Godown is used for storing finished products. Besides two main products, 1000 units of a byproduct also emerged. Aha! In the production process, what also came? Byproduct also came. And the byproduct order selling price is 12 per unit after incurring an expense of 2500. Not only byproduct, even there is a scrap. Appo nee pathana, in the production process la, they got FP1, they got FP2, they got a byproduct, they got scrap also. Rendu produce panna nalu kachirukku. FP1, FP2, byproduct, scrap also they got. Okay. The average market price of FP1 is 160 per unit and FP2 is 100 per unit. Calculate the value of closing stock of FP1 and FP2. Okay. So let us solve this question. A very, very interesting one. Okay. Listen everybody. First, how much is the total common cost? Materials consumed 3,20,000, labor 1,60,000, so total 4,80,000 plus direct expenses 78, so 4,80,000 plus 78, 5,28,000. Listen, not yet over, wait. Finished fixed overheads is 95,000, but listen, in this 95,000 there is a godown rent. You would have learnt in exclusion from cost. Rental cost, or in other words storage cost, should not be included in the cost of inventory unless it contributes value to that. Store panna idoda value ஏறும். அந்த மாதிரி ப்ராடக்ட்ஸ்க்கு மட்டும்தான், only for those type of products alone we can include storage cost in inventory. If it is a normal product, sir, for example, I am manufacturing this mobile phone. This mobile phone, if you store, will it value increase? No sir. If I store for 1 year, mobile phone will be more valuable. Nothing like that. So for these type of mobile phones, storage cost will never be included in the cost of inventory. Here they have not told that storage is adding value to the product. So storage cost, we cannot add it to the value of inventory. So 95 minus 15, only 80,000 can be taken. So total common cost is 6,08,000. Either that we have to split between FP1 and FP2. Before that we have two more, byproduct as well as scrap. Ada first tackle pannittu, then we'll come to this. Inga paare, how many units they got byproduct? 1000 units, correct? I told you byproduct should be valued at NRV. So 1000 units. Selling price is given to you in the question, 12 rupees. So 1000 into 12, 12,000 is the selling price. For this, they had to spend 2,500 expense. Upon netta, 12,000 minus 2,500, 9,500 is the NRV of this byproduct, which should be subtracted from common cost. Is this clear? And Another 4,800 was also realized by selling scrap. நீ மொத்தமா 6,08,000 செலவு பண்ணா ஒரு 9,500 you got it from byproduct, that you subtract, remaining will be your net cost. You got another 4,800 rupees from selling scrap, that also you subtract, minus 4,800, remaining minus 9,500 minus 4,800. So net cost is 5,93,700. Okay va? So நீ பார்த்தனா totally 3,20,000, 4,80,000, 5,28,000, 1 minute, plus 1,60,000 plus 78,000 plus 80,000. Guys, sorry, I made a small mistake. This should be 3,20,000, addition mistake, not conceptual mistake. 3,20,000, 4,80,000, 5,58,000 plus 80,000 should be 6,38,000. So 6,38,000 minus 9,500 minus 4,800 will be 6,23,700. Okay, now this should be split between FP1 and FP2. Sir, how to split? Based on the market value of FP1, FP2. நீ பாரு, FP1 how much you produced? 3,000 units you produced. அதோட market value is 160. So 3,000 into 160, 4,80,000. Same way, let us once check it in calculator. Paka 4,80,000. FP2 we have manufactured how many? 1,600. 1,600 into what is the value? 100. This will be 1,60,000. Appo in the 6,23,700 you have to split in this 4,80,000 is to 1,60,000, which is 3:1. In this 3:1 ratio you have to split. So if you split that 6,23,700 in the ratio of 3:1, 6,23,700 divided by 4, kitna 1,55,925. In this into 3 if you do, you will get FP1 ka cost. 4,67,775 will be the cost of FP1 and 1,55,925 will be the total cost of FP2. So we have arrived at total cost. இப்போ இத per unit மாத்திரலாமா? So 4,67,775. How many units totally we got? 3,000 units we got for FP1. It will be there in the question. 4,67,775 divided by 3,000. 155.925 is the cost per unit. How many units we have in inventory? Inventory we have 500. So into 500, this into 500 will give you the cost of inventory of FP1. Adhe mari 1,55,925 is the total cost of FP2. How many units you produced in FP2? We have totally produced 1,600. So this divided by 1,600 will give you which is 97.45 is the cost per unit. Sir, how many units in inventory we have for FP2? For FP2 we have 300 units in inventory. So this 97.45 into 300 will give you the cost of inventory of FP2. Hope you understood this very clearly. Okay, so this cost you have to multiply with selling price. Whichever is lower will be the value of inventory. So totally finally show like this: total closing stock of FP1, FP2, and then even raw materials also they have given initially. They have given cost price and replacement cost. See if there is any problem at FG level. If there is no problem, cost this raw material will be valued at cost itself. Here there is no problem at FG level. Sir, how can you tell, sir? Because FP1 ku selling price per unit is 160. Correct? What was the cost per unit that we arrived? 155.925. So cost is 155.925, yeah. Selling price 160, yeah. Cost is less only, so no problem in FG. So no problem at raw material also, that can be valued at cost. FP2 ku par. FP2 also if you see, cost per unit is 97. Ana adoda selling price was 100. So again cost is less, so no problem at FP2 level also. So again for raw material, no need to check replacement cost. Take the cost per unit, multiply with the number of units, calculate the closing stock of raw material. You understood this question, a very very interesting question. So first we will take common cost. In that don't take storage cost. From that subtract the byproducts NRV, selling price of byproduct minus other expenses will give you the byproducts NRV. Subtract that, then subtract the scrap value, then remaining what you get is the common cost, which needs to be allocated to FP1 and FP2 in the ratio of sale value. Take the FP1 units produced, multiply that with the FP1 market price, you will get sale value of FP1. Take FP2 produced units, multiply with the market price, you will get sale value of FP2. In this ratio you split, you will get how much cost for FP1, how much cost for FP2. Divide these by total units produced, you will get cost per unit. That should be multiplied with the number of units in inventory, you will get the total cost of closing stock. That can be compared with selling price, whichever is less will be the actual closing stock value that should come in the balance sheet. Able to understand this? Okay, so please ensure you practice this sum once. In the question bank, there are 2 more questions like this. You can also use that for practice in case you think you need more confidence. Okay, last ஒரே ஒரு குட்டி cute question. Question number 5. Kirti Limited is in the business of manufacturing computers. During the year ended 31st March 2024, the company manufactured 550 computers. It has the policy of valuing finished stock of goods at a standard price of 1.8 lakh per computer. The details of the cost are as under. Okay, see, இவங்க வந்து என்ன பண்றாங்க, they are following standard cost method and they are going with a value of standard cost of 1.8 lakh per computer. They have given us actual cost. They are following which method? Standard cost method. And what is the standard cost per computer? 1.8 lakhs. Sir, இது வச்சு நான் என்ன சார் பண்ணணும்? நீ என்ன பண்ணணும்? 1.8 lakh per computer is standard cost per computer. They have given you actual cost or details also. From that we will arrive at actual cost per computer. We know standard cost per computer. We will arrive at actual cost per computer. If these two are deviating materially, then you should say you should use only actual cost. If there is no deviation or if there is immaterial deviation, then we can allow the company to follow standard cost. Let us calculate actual cost per computer. Per raw materials consumed 400 and then direct labor 250, so total 650. 150 is variable, so total 650 plus 150 is 800, and then fixed overheads, Gavani, including interest of 100 lakhs. Remember, interest cost can be added to the value of the inventory only if it is satisfying the definition of qualifying asset as per AS 16. Qualifying asset means an asset which takes a substantial period of time to get ready for its intended use. Substantial period, not 12 months or more ஆச்சிருக்கணும். இங்க computer manufacture பண்ணதுக்கு 12 மாசமாட ஆகும். So computer is not a qualifying asset, it is a normal asset. So interest cannot be added to the value of inventory, it should be taken to P&L. So we cannot take 290, we can take only 190 from that. So 800 plus 190, total 990 lakhs is the actual cost for manufacturing 550 computers. Let us see what is the actual cost. 990 divided by 550, 1.8 lakhs is the actual cost also. Wow, this company is amazing. 1.8 lakhs is the actual cost also. 1.8 lakhs is the standard cost also. So we can allow them to value it at standard cost itself. Sir, இப்படி வந்துச்சு, suppose எனக்கு examல if I get something different, suppose I get 2 lakhs or I get 1,50,000, then what I should do, sir? Write the conclusion as, if this deviation between actual cost and standard cost is considered to be material, then the company should value the closing stock only based on actual cost. However, if this deviation is immaterial, what is material, immaterial, how will we know? We have to judge based on the circumstances in that company. However, if this deviation is immaterial, then you can continue at standard cost. Is this clear? So this is how you have to conclude. A very simple standard. Be very strong with the measurement principle on the cost or NRV, whichever is less. Raw material principle, cost or replacement value, whichever is less, you should do only if there is a problem at finished goods level. Idhulu romba strong ah iru. Okay, and then the joint products, byproducts sum you do well, and be very strong with that finished fixed overheads. Fixed overheads, to calculate per unit of fixed overhead, if there is underutilization, you will divide by normal capacity. If there is overutilization, you will divide by actual production. So these are some of the important points, and then if you do these sums, definitely you will be able to handle any question in the exam. Okay, this is what I wanted to revise in AS2. I'll come back in the next video with AS10 and AS26 together, because both are related standards. Thank you so much. Meet you in the next revision video.